Today I'm going to be talking about PayPal, ticker PYPL. Shout out to my boy Rocco Costanzo, college buddy of mine. In fact, why don't I read what he said? Overall, I still feel the intrinsic value of the PayPal and Venmo brand are undervalued. I think it'll come with margin expansion and efficiency gains. And then on a more speculative note, I think these platforms will be on the beneficiary side of AI software. Through fraud prevention, customer service, credit checks. All of that seems very reasonable of a thesis to have on PayPal. I'm going to be taking a look, as I always do, through the same lens of what is the company, what do they do, what's some background, the financials, the valuation. We don't have a dividend, so we won't be discussing that. I'm going to discuss some of the risks and then technical analysis, as well as give it a grade. So, what is PayPal? Well, PayPal is a payment processing platform. In fact, it is a two-sided network connecting merchants and consumers. Two-sided meaning sending and receiving payments, both like peer-to-peer, B2C, B2B. So you have the PayPal and Venmo brands, but then you also have PayPal Credit, Braintree, Zoom, Zettle, Hyperwallet, Honey, and Paydi. Half of those I'm not familiar with. However, I am familiar with Venmo, PayPal, PayPal Credit, and that's all I've heard of up to this point. It's a large cap, $65 billion company. Very low forward price earnings multiple. You see here, over 5 years, it's down 28%. Not good. Again, we don't have a dividend, so the price return is what you get over a roughly 10-year time frame. The stock is up 89, 90%. It IPO'd in the $30 a share range at 65 today. At one point in mid 2021, the company was nearly $300 a share. And I mean, you see here, as such, has steeply sold off. Even earlier this year, just a few months ago, before earnings, their most recent earnings, the stock was $90 and is down now 65. In fact, it could have been had July of last year for 57 before it appreciated about more than 50%. And we've basically round trip. So what's going on? Does this company have a moat? Payment companies, very lucrative. Okay. Very lucrative, very scalable, inflation protected. Earn a tiny sliver of every transaction through your gateway. Great business, right? Well, of the value chain of payments, particularly digital payments, I see the credit card networks, the payment, the interchange network, we'll call them, Visa and MasterCard being in the S tier, the super powered tier of payment networks. And then below that, you have American Express and Discover, almost as good, but not as good because they have to, they're more like banks, whereas Visa and MasterCard don't hold funds, right? They just process transactions, hyper scalable. And then below those companies are all the other companies, of which PayPal is one. So PayPal, of course, you can have a balance in your PayPal account, indicating that PayPal is kind of like a bank, kind of, but in order to process using a card, they still have to use the payment duopoly. In fact, I'll just give you a sense of what I'm discussing here. So let's take a look at this. Driving progress across key initiatives. Win checkout. Scaling the highest converting checkout experiences. 25% of US branded checkout traffic on upgraded experience. Scale Omni. Building momentum beyond e-commerce. Nearly 100% PayPal debit card TPV growth. Grow Venmo. Driving adoption of monetized products. Accelerate small medium business with end-to-end solutions. Okay, What do you notice about this slide here? I'll tell you what I notice. Mastercard, Mastercard, Mastercard. So even though Venmo, or excuse me, PayPal has kind of the gateway to these payments and they're scraping fees off that, who's the real winner of this? It's Mastercard, right? They're making a cut of all those transactions, and they don't have to deal with the balances. So maybe now you're gonna see that I have a certain belief system around the payment infrastructure, digital payment infrastructure, and ecosystem, and my investment thesis does not include companies like PayPal. As we do from time to time, we're going to take a look at the Morningstar report to discuss the moat of which they describe as narrow. We see that but the Morningstar analysts have it fairly valued at $104, and we see that it is far below. In fact, ever since this point here in 2022, early 2022, it is traded far below fair value. Brett Horn from Morningstar wrote, excuse me, on the 24th of February, in terms of the economic moat, payment processing of any type is highly scalable. True. As once a payment platform is established, there is little incremental cost to additional transactions. Very true. So it's saying that they have material scale with over 1.7 trillion in volume, falls short of volumes handed by other fintechs, Fiserv and WorldPay. Within the e-commerce space, PayPal is a clear leader, which we think places a narrow moat. So, in other words, this right here, some sort of e-com interface, PayPal is a good option. All right, PayPal happens to be integrated with a lot of e-com payments. Its relatively unique model centers around a two-sided platform, with PayPal enjoying relationships with both merchants and consumers. We think this approach has material benefits and was instrumental in allowing PayPal to develop its current foothold. So they acknowledge that PayPal has a network effect. We typically think of a network effect as a very strong source of advantage and one that often gives rise to a wide moat. In PayPal's case, though, we think that the effect is much more mild, as the company is a relatively small piece of the overall electronic payment infrastructure. My big heartburn with all these fintechs is they all just appear to be some sort of wrapper at the end of which there's a debit or credit card that Visa, MasterCard, American Express, or Discover is actually making money on. And I think what we're seeing is the same with PayPal. So, to give weight to those numbers, what I would expect to happen, what I would expect to see in their financials with that thesis is a gross margin profile that isn't great. So, let's just do a very quick scan of the income statement over the years. We went from 9.25 billion of revenue to 30, almost 32, 31.8 billion of revenue in the trailing 12. Again, highly scalable. However, when we look at gross profit, 4.7 billion to 12.9 billion. I don't know if you can see this in the camera, but the calculator, I calculated that the revenue has grown almost 3.5 times. However, gross profit has grown 2.74 times. Okay, so what does that tell us? Gross profits have the margin has decreased over time. In fact, we see that here, 4.7 billion over 9.25. That's more than 50% gross margins. However, for 50% margins on 32 billion, we would expect 16 billion of gross profit. We see that that is not the case. So gross profits have come down over time, which is indicative of a lack of strong moat. The real, true gross profit margin expansion is accruing to MasterCard in this case. Let's look at that. We've never analyzed MasterCard on the channel before. Okay. But take a look at this. Revenue is gross profit. from 9.6 billion to 28 billion. Isn't that interesting that our revenues at PayPal have grown roughly in lockstep, if not more? That's not even 3 times, right? Pure gross profit. So that's actually slightly different numbers than what I was saying, because the whole idea is, oh, well, you've got margin expansion over time. You can't expand anymore when your margins are 100%. So that gives you an idea. This business is 100%. I keep saying Venmo. PayPal is a salesperson for your business, highly scalable. I don't like that. I don't like the fact that my gross profits are not increasing as fast as my revenues, right? Operating income, though, looks good. 1.5 billion to 5.6. That is about the same pace as revenues. So they are able, it does appear, to get some sort of operating efficiency in the OpEx level, whether that be through payroll, marketing expenses. You see R&D, SG&A, and other OpEx like salaries and stuff. It's kind of moderated somewhat. This is the main kicker we have to care about: is shares outstanding, 1.2 billion to 1 billion. Massive decrease in share count. And that has led to accretion in terms of earnings per share, going from $1 to $4 a share. The income statement looks good. My thesis here is that this company will not outperform MasterCard or Visa, right? That's kind of that's the competition for my dollars, right? In the competition for my investment dollars, why would I invest in PayPal when I can invest in this? It's reinforcing my opinion. So let's get a little bit more into the weeds with and zoom in on the financials. Total payment volume, or TPV, year over year in the quarter. Again, this is a quarter in which we saw the stock sell off from $90 to $77. So that's like 15%, more than 15%. The stock sold off on this earnings report that we're looking at. Total payment volume rose 7% year over year. But revenue in the quarter of 8.3 grew 4%. So again, that kind of gives you an idea of what I'm looking at there, where our payment volume that we're processing rises by 1, but our revenue doesn't rise by 1. So what's going on there? Why is that not happening? I guess in this case, if you had total payment volume coming through here, some of that would go towards MasterCard. But the fact that that's not increasing at the same rate is concerning to me as a shareholder, because why are my fees, why are my percentages of the dollar volume on the network, why are they not increasing? That's a big question mark. When I look at these numbers, I'm like, I don't like that. I don't necessarily feel like I can explain it, why that's happening. I just know that I don't really like it. And it leaves me with more questions than answers and confidence. Non-GAAP earnings per share up 5% year over year. The fiscal year, the full year numbers look better than the quarter numbers. So we are seeing some deceleration. Whether that's a trend or not is unclear. Isn't that interesting that we see payment volume increase 1 and revenue increase by less than 1? Why is that? Is that always the case? It'd be great if we could see this number going back to inception, but we don't. And then this gives you an idea of where the volumes are across all of the products. Branded checkout is like this, right? Branded checkout is that's 30%. Unbranded card processing is this, maybe. That's the largest group. And then Venmo, the next largest. So let's look at the guidance here. So notice something. So here you have your total revenue, right? And then you have transaction margin. Is that just gross Is that just gross margin? It's unclear how these, I mean, obviously we recognize that number. That's the exact number that they reported here. But what is that exactly? I don't know where that is. Okay. So I'm a little perplexed by this transaction margin. If somebody watching this understands, then let me know. Okay, but I'm confused. In the quarter, they returned 1.2 billion. This is the big catalyst here that I see. This is not, we've talked a lot of negative things about the company. Let's talk about a positive. 1.2 billion in share repurchases, 6 billion on a trailing 12, reducing weighted average shares by 6%. I mean, that's huge. So, in other words, top line is growing by single digits. Operating income is growing by double digits. The fact that we're able to generate so much cash to repurchase shares, no wonder our earnings per share is going up by 21%. That's really, really strong. So, what do I see here? Financial engineering driving a stock. Why do we not show revenue and we show transaction margin? But if we kind of take this as our top line proxy, we see mid single digit 4 to 5% growth, generating 6 to 7 billion of free cash flow, of which almost all is going to go into share repurchases, which is going to accrete 6 to 10% growth in earnings per share. When a company is dumping so much money into share repurchases, again, they're saying, hey, this year we're going to dump $1 billion into buying our own stock. Well, our stock is worth 65 billion. So in theory, that should drive actually significant amount of share appreciation, right? That first off, that increases the demand for shares. Shares are like anything else; they have supply and demand. So that's a catalyst for the stock price to move. The financials, they leave me with a lot of question marks again when I'm talking about anything in the payment space. There's certain levels of the value chain, and I don't like these numbers nearly as much as I like um, some other companies that I've mentioned here. So there's a level of bias there. Nothing about these numbers makes me really change my opinion. Um, the growth numbers look okay. There is some slowing growth here, which it could be material. It could be a sign of a trend. It could be nothing, right? But obviously, I think it's clear at this point, or if it's not, it should be clear that the only thing that makes this look like a potentially compelling investment is the fact that they're just buying back a bunch of stock, a significant amount of their stock. So could that move the stock price significantly? Well, it could. Obviously, we see how volatile it is. 50% round trip down 30. So very volatile. I would argue that it's correlated to the index, but more volatile. And we can, do our best to confirm that here in a moment. But first, I want to talk about the valuation. Um, Price earnings of 13, 14 times. I mean, that's incredibly low compared to some other companies in the market. The 5-year average of PayPal stock is skewed by this period here, of which we just see this insane valuation. So it's significantly less money today than it was at that time. So we see compared to financials, most of our metrics are very good, with the exception of price book, which makes sense because banks and insurers have very large book values, especially compared to their enterprise value. So an 8 times price cash flow. We had here 6 to 7 billion of free cash flow versus our 65 billion market cap. So I think the valuation is very good. I would argue that it's better than the C grade that Seeking Alpha has. I think it's a good valuation, very very good valuation, especially when looked at through the lens of what they're gonna repurchase. But what are some of the risks? Okay, let's discuss the risks. I mean, first off, very volatile stock. Okay, volatility is an opportunity in the markets. We know that, but right off the bat, volatile. Not only here did it sell off a lot on earnings, but again, if you remember, February 19th is kind of when when markets started to go into this backslide. Right here is when the S&P started its backslide. It looks like this stock is more or less done the same. We see here. So from the day that markets have gone down, the S&P 500 is down 8.66%, PayPal's down 16.73%. So what does that tell us? It tells us that, I mean, you see these daily moves. It's basically it's highly correlated with the index and has a higher beta right now. So that's your risk. Your risk is the volatility. And with the market being in a bad place right now, the US market being in a bad place right now, are you finding a place to hide in PayPal stock? I don't think so. I think the data shows us that that's not the case. Okay. So that's your short-term risk. Your long-term risk with the stock is just and this is more of an opinion, but your long-term risk, it's not that it won't perform well. It might. It's particularly if they're able to continue um, returning that much cash to shareholders. Just like Visa and MasterCard, this company is returning almost all of its free cash flow to shareholders. The difference being that Visa and MasterCard pay a dividend, PayPal does not. Okay. So the stock could perform well over time. However, I would argue that it does not perform as well as, again, where the value is accreting to the most. If we take a look again at what Rocco said, the one thing he's talking about is margin expansion. I think margin expansion would definitely be it would throw a wrench into the negative thesis that I have. I guess what I'm arguing is that margin expansion, why would margin expansion happen exactly? I couldn't tell you how. I'm not saying that it couldn't. I don't know how it would happen, particularly because the company does not have the wide moat that the interchange networks do. Therefore, their margins will always be stronger as long as that's the case, and that's my assessment on that. So I don't know if it'll happen or not. It might, and if it does, it'll definitely cause it'll catalyze the stock. However, I do not believe that in the long run this stock will outperform MasterCard, Visa, American Express, or Discover. Just on the thesis of moat versus wide moat and moat alone versus anything else. So, last but not least, let's take a look at the technical analysis. Each of these candles is a day. So from the mid 2024 lows, the stock was in a very bullish, very, very bullish uptrend. But what happened was that the stock kind of was breaking towards the trend line, and then earnings happened. And you see here the stock gapped down. Here it ended the day at $89. And then the day of earnings, it started the day at 82 and ended at 77. So from 89 to 77, $12. Um, I mean, that's close to 15% drawdown in one day. That's insane volatility. And then here it recovered somewhat, but then you have the macro weakness happening. So if you haven't looked at my video about the S&P, and how technically the market is not in a good place. The US market is not in a good place, technical analysis wise. And because it is of my belief that this company is highly correlated but more volatile than the index, I feel like it's not a good time to buy it. In fact, my my grade would I'm gonna give kind of two perspectives here. One, there's the long-term grade. If I already have shares and I'm here, I would hold it. I wouldn't sell it, I would hold it because I think it'll do okay. If I'm thinking that I can buy it here and I'm gonna do well versus the market, I'm highly skeptical about that. So my grade really is to just continue to avoid. However, um, it could do well. I don't I think we're seeing a perfect storm here of macro weakness. This is a more discretionary company. You got its earnings tied to discretionary cash flows somewhat. I don't think it'll outperform. But the kicker being if the shares do sell off a lot more than they are now, again, the company's buying $6 billion. They plan on buying $6 billion of stock. Um, you know, not only does that create demand for the shares, and kind of create somewhat of a price floor for them, but it definitely backstops uh, earnings per share growth. Earnings per share growth, assuming that their guidance holds here, earnings per share growth um, might outperform the 6 to 10% significantly, actually. Um, but I wouldn't grade it a buy just because of my biases and also my strategy and where we are in the market cycle. I can't recommend that it's a buy, but you get the idea of what I'm saying. I wouldn't grade it that way. In fact, I would avoid it. But if over the long term you think that these buybacks accrete a bunch of earnings per share and it just continues to get cheaper and cheaper and cheaper, that would be great. Now, again, I think my opinion would be substantially different if it had a dividend, because if, let's say, it was paying a dividend, in fact, we see here on $5 of earnings per share, 20% being a dollar, that'd be 1.5%. Again, remember, its payout ratio to shareholders is like 100%, right? So even if they took 30 to 40% of that and put it towards a dividend versus the buybacks, you have pretty good yield um, for a stock. So if they were to allocate some of the money towards dividends, but still the majority of it towards buybacks, let's say that they put 20% towards dividends, that'd be a 1.5%, and 80% to buybacks. 80% of that would be what, 5.4 billion of share repurchases. That's still like 7-8% of the market cap, and that gives you an idea of that they could be increasing this dividend by double digits every year, and that would be a much more attractive company for me because I want to uh, receive a cash flow, an actual cash flow from the stock, and I want it to increase year over year. So I will qualify my statement by saying the fact that it doesn't pay a dividend is it does dampen my enthusiasm somewhat for the company, because of that reason, because their shares are undervalued. Well, they're cheaply valued. They're buying back so much stock. Just pay a dividend, like accrete that cash flow to shareholders. So that does dampen my enthusiasm somewhat. Um, but technically speaking, chart doesn't look good. Not only did we break through this downtrend, significantly gap down, but we're now, below this former resistance. You know, this is a lot. Look at how many times the stock bounced off that level and failed before it started to trend up. We're now below that level again. So I think technically speaking, the chart doesn't look good. The stock market as a whole doesn't look good. There's nothing about the company that implies more safety than the market. So my grade it would be to avoid it. But that being said, it certainly is much more attractively valued than a lot of things out there. It just doesn't really fit my profile or strategy. So take what I'm saying with a grain of salt and understand that I have certain biases, as all investors would. And maybe it fits your strategy very well, in which case, maybe investigate some of the things that I've said. That'll conclude our video today. Hopefully, this has been interesting and useful, and it has opened your mind, if you are watching, open your mind to an alternate perspective of the company. Um, but I certainly do understand why an analyst could say that it's a strong buy. I really do understand why somebody could say that, and frankly, I think that out of all the stocks that I've seen that have sold off so much in recent months, um, such as Nike, Tesla. Those are both things that I've given very negative ratings, very negative analysis to. I would say that this company is far better than either of those, if in terms of the actual valuation. So there, I will say that, but it doesn't really change my view in terms of if it's investable or not. So, anyways, hopefully this has been hopefully this has been useful. And let me know how I'm doing. Comment and let me know what else I can cover that you might be interested in. As always, like I may or may not have mentioned, with Seeking Alpha, the platform that we're using here, of course, I contribute analysis. I've been doing, 5 to 6 articles a month. I'm really trying to increase that volume to get more of my thoughts on paper. But also, if you're interested in utilizing Seeking Alpha as a platform, the pro plan is what I use in the videos that allows access to the quant rankings, and to the full analysis here, which is good. So if that's something that interests you, you can get $30 off the plan and have a 7-day free trial. And that link, as always, is in the description. So with that, I'm going to conclude, but hopefully you've enjoyed as much as I've enjoyed, and I will talk to you next time. All right. Have a good day.